As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We have a longtime returning guest tonight. Craig Hemke, founder of tfmetalsreport.com, is here again with us on Reluctant Preppers. Welcome back, Craig, for joining us on Reluctant Preppers.
Donegan, it is always a pleasure. Nice to visit with you again.
We met in person at the second Liberty Mastermind Symposium in Las Vegas, Nevada, and introduced ourselves to each other. And I learned a little bit about your background at that moment. If you could remind our viewers of where your background lies and what led you to the position that you have as a commentator on the precious metals markets.
Well, I started out, it's really all I've ever done, actually, has been involved in what they call the securities industry. Even before I got out of college, I was trading options on commodities. I've got some family that's in the business, if you will. And I became a stockbroker and got all my licenses in 1990, Donegan. So it's like half a life ago. And I was in a stockbroker. I was in the wholesale distribution of financial products for a while, where I traveled around and met with a bunch of stockbrokers and financial planners, and always believed in the system, at least as I understood it. I mean, I thought I understood it at that point. By about 2008, my kids were getting older, and I decided I didn't want to travel anymore. I was gone 3-4 nights a week. And so I decided to start my own business. And in the process of watching that business fail, I had a chance to observe, I guess, things on a daily basis. You know, we're talking right around the financial crisis and in the months that followed. And I finally had my eyes opened. And it was like a great awakening. I figured out that so much of what I thought I knew, I was dead wrong. And that I'd been kind of led into this forest of belief in the system. And it took me that time to really kind of open my eyes. I started reading a site that at that point was in its infancy, called Zero Hedge. I mean, it started out as just a blogspot site on Google. And I started reading it then and watched it grow and really began to learn what was really going on, what was really driving the markets, the intervention of not only the Fed, but all the other central banks around the world to prop it up. And it was through my association with Zero Hedge that a number of the folks there, the readers there, encouraged me to start my own site. And that morphed eventually into a dedicated site at tfmetalsreport.com. And here we are some 6 years later, going strong. Never had more subscribers and site readers than we have at present. And we've made it through the storm, if you will, for precious metals. And now we're all very excited to see where it goes from here.
And that leads us, if we could fast forward to recent events, we've certainly seen after like a 5-year doldrum in precious metals, which according to Bill Murphy and others has been engineered at the hands of central banks to press down, artificially suppress the prices of gold and silver, that in the last 2 quarters we've seen a significant rebound to the tune of 30 to 50%, depending where you count from, in both gold and silver. And if especially renewed excitement over the past month with the Brexit vote in Europe. And if you could kind of take us through what you believe to be the macro forces that have been driving both the suppression and now the apparent breakout from a bottom of precious metals, and just bring us up to the current day.
Well, there's kind of a double whammy involved going forward, in that 2 of the most significant, perhaps maybe simply the most significant fundamentals for owning physical gold have both occurred, kind of playing off of each other in the last 30 to 45 days. Those 2 things are the Brexit vote, which in itself doesn't destroy the European Union and the euro currency, but it is a fatal wound to the euro currency. And the euro currency, I mean, man, that's the second largest, second most used, second most popular fiat currency in the world. When that thing dies, I mean, it's not just as simple as, going back to Deutsche Marks and Lira and all this other stuff. All of the banks that have trillions and trillions of derivatives that are priced in euro, I mean, it's a disaster waiting to happen. And so that's the first reason driving physical gold purchases. If the fundamental driver is if you're uncertain, if you live any place where the euro is your currency, I mean, for crying out loud, you've got to own gold. You also have to own it if you're in England. The British pound is down 10 to 15% since the Brexit vote, but gold priced in pounds is up about the same amount. So your gold, it did exactly what you wanted it to do in a time of currency crisis in England. So that's one fundamental factor driving gold forward, and physical demand for gold. And that's the important thing here. The second part is negative interest rates. We've never in the history of mankind really, I think, dealt with a regime of negative interest rates where instead of the bank paying you to borrow your money and store it with them, or the government or whatever, you now have to pay them. Well, that doesn't make any sense at all. But that's where we're headed. That's getting deeper. $14 trillion worth of negative interest rates around the world, or debt with negative interest rates right now. It's growing by the month. And that is an even greater fundamental driver of owning physical gold and silver. In that, Dunnigan, the argument always was, why would I want to own gold? It just sits there, collects dust, doesn't pay a dividend. Well, no dividend at all beats the pants off of negative 2% in interest, right? So that is those two things combined will drive gold forward, and we'll talk about the implications of that next, if you don't mind. Getting back to why gold turned, these markets, if you will, and if people could see me right now, when I say the word markets, I'm doing like the little air quotes around it, okay? The markets, what you think are markets, are instead high-frequency trading computers programmed with algorithms that swap things back and forth at the speed of light. There is no human rational involvement at all. I mean, very little, let's put it that way. Maybe 20% of the volume on the New York Stock Exchange is actual human beings, buying a couple hundred shares of Coca-Cola. The rest is just this swapping of positions back and forth by these computers. Same thing in the paper gold and paper silver markets that determine price on the COMEX in New York. So if those HFT machines are moved to either buy or sell the paper metal, then that's what's going to happen to price. It's either going to go up or down. And one of the key drivers of making those machines either buy or sell the paper metal is, curiously enough, the one forex pair, foreign exchange pair of the yen versus the dollar. We call it the dollar yen. As that has risen, gold has fallen since 2012. Actually, rather counterintuitively since 2012. Well, beginning in 2016, back in January, all of a sudden, that dollar yen reversed. The yen got stronger. The dollar yen went down, and with it, paper gold shot higher. That's what caused the spark in the first quarter. But now going forward, what's really driving things and what is really exciting is this twin regime of negative interest rates and the looming death of the euro.
And yeah, when you mentioned negative interest rates, it's always been criticized that precious metals are non-productive assets. And as you said, people throughout the equity market boom, the stock market boom of the last part of the 20th century, everybody was saying, gee, why would you park your money over in this cul-de-sac of precious metals which do nothing for anyone? But instead of putting them into productive, innovative companies that are changing the world, like Amazon and Google and that sort of thing, and even the safe havens of treasury bonds and so on. But in the arena where ordinary interest-bearing accounts and CDs and everything have gone close to zero, and some of these banks and even some sovereign debt like Germany is going to negative rates, it really does turn everything up on its head, to where people were sneering at precious metals, which we were people who were precious metals enthusiasts all the time were saying, yes, but it's a long-term store of value, and that didn't seem very attractive. But as opposed to something that's shrinking, something that is a store of value all of a sudden takes on a different attractiveness. And in the face of that, this increased demand that you've described as coming out in burgeoning physical demand in Europe and the U.S., and is that, what are you watching that's going to indicate to you whether that's going to be sufficiently strong to overwhelm the, as you mentioned, the computer-rigged paper price manipulation?
That's the question, Dunnigan. As long as I've been in this, I have railed against the bullion banks that we call them, the banks that are in charge of delivering physical metal at the spot price, primarily in London, excuse me, but they also operate in New York on the COMEX exchange. And that exchange, that electronic futures exchange, operates in derivatives. They don't trade physical gold at all. They hardly deliver any physical metal at all compared to global demand. And yet, that paper derivative price is what still sets the physical price. It doesn't make any sense at all. And you end up with this whacked out gold silver ratio of 70 to 1. I mean, historically, it's 15 or 20 to 1. How to get to 70 to 1? Well, that's a reflection of how uneconomically and stupidly priced things are using paper derivatives trading to determine that price. Well, the only thing that backs that paper derivative system is the physical metal itself. And the physical metal is priced as if it is abundant when it's not. It is actually scarce. What's abundant is the seemingly endless supply of these derivatives. So if we're ever going to break this system, if we're ever going to get to a place where physical metal, exchange of hands of physical metal actually determines the price, rational, economic determination of price. If we're ever going to get to that point, we have to break this paper derivative system. The only way that the paper derivative system ultimately breaks is if suddenly the confidence game of just-in-time delivery for anybody that does want delivery out of the paper system, suddenly that confidence game fails. How does it fail? I don't think it's necessarily a delivery failure on the COMEX. It may instead be a delivery failure out of some unallocated account somewhere at a bullion bank in Europe, where someone is told, don't worry about it. Yeah, your gold's just pooled in with everybody else, and if you ever need it, you can come to the vault and we'll give it to you. And suddenly somebody does go to the vault, and they do want to switch their unallocated account to allocated, getting their hands on it and withdraw it, and then they're told, I'm sorry, you can't have it. What? And that's where it gets exciting. And as you mentioned, the key driver here of that physical demand is the negative interest rates. Think if you were a German or a French or a Dutch citizen, what are your options for safety? Or not even a citizen, a pension fund or somebody with big reserves like an insurance company. And you're looking around for your safe money. You don't want to take it, really any risk. Well, let's see, what could you buy? In both Germany and the Netherlands, 10-year government bonds have a negative interest rate on them now. So you buy $100,000 worth of government bonds, you're going to get back $99,000. No interest in between, $99,000 when they mature 10 years from now. That doesn't seem like a very good deal. Now, at the same time, your currency that you deal in, the euro, maybe just going away or at least weakening considerably. Well, that's a double whammy. I want nothing to do with that. And then you open up your paper, and you read that gold is up 25% this year. And you think, dang, that ain't bad. I know it doesn't pay a dividend, but even if it just does 5% the rest of the year, that beats the pants off of my government bonds and my currency risk and everything else and the counterparty risk. I think I want some of that. Oh, and I've read some of the stuff that I don't want the GLD. I don't want just exposure. I've read that I better be safe and get the real thing. All of these people coming wanting the real thing pulls the rug out from under these bullion banks. You think of Dunning and I get you. We probably all played that Jenga game, where you've got the stack of the little rectangle cubes, and you pull one out and you put it on top, and you pull one out and put it on top, and then suddenly you pull one out and the whole thing. That's what we're waiting for. That's where we're hoping the physical demand will ultimately, one last little rectangle will come out and the whole bank system will collapse. The bullion bank system will collapse, and then actual physical exchanges where actual physical metal is exchanged, whether it's something like the allocated bullion exchange or even the Shanghai gold exchange in China, that regime will take over. A price will be discovered that's an actual true exchange of physical metal, not these paper derivatives. And then we'll just see what the price is. And then if you wait till then to buy yourself some, I mean, if everybody else can't get their hands on any, you're not going to be able to get your hands on any either. Not you, but anybody listening to us. I mean, the time to prepare is now.
That's what I was
asking. The time to
asking
prepare
next.
is now.
is, do you consider, even despite the fact of the recent run-up from bottoms in both gold and silver, do you consider the current prices to still be compelling for people who are either have been late to consider entering or who may have been waiting for a good time to add to their positions?
Really, the best strategy is what we've been doing for the last 4 or 5 years. I mean, there are a lot of folks out there saying, "Oh, I don't want to buy silver or gold. You know, it was 1,800 a couple years ago, and I got stuck with it. It's only 1,300." Well, look, if you were smart enough to just keep buying it a little bit at a time, you'd be like where I am now. My cost basis on all of my physical silver and gold is lower than where the current price is. And that's what you should continue to do. Just keep buying a little bit at a time and taking delivery while you can. Because as long as these banks are involved, as long as the paper derivative price is what determines the price at which you can actually swap your paper money for physical metal, then all kinds of games are going to be played. We saw it this week. Why did gold go down $30 Monday and Tuesday? Because that dollar yen I talked about earlier shot about 4 points higher because the Bank of Japan started talking about new stimulus programs. Didn't have anything to do. Didn't have anything to do with physical gold demand or the fundamentals of gold. Gold went down $30 because the yen weakened. It doesn't make any sense. It doesn't make any sense. But that's where we currently stand. That's the regime that things are priced under. So, is it smart to be buying some? Yes, because when the time eventually comes that this system fails, and nothing goes on forever, nothing goes on forever. When the time comes that this system fails, the price isn't going to be $1,300. Like I said, the current price makes you think that metal is abundant. It's not. What's abundant are these derivatives that they trade back and forth, at the speed of light. And the fact that they somehow, for some reason, still price physical exchange and metal at that paper price is something people need to be taking advantage of.
Now, there's been, and even advertised on your channel, there are some exchanges which are not based on paper only, but hard bank assets, or hard asset banks, such as Eric Sprott and Rick Rules. Can you talk a little bit about the tendency or the emergence of non-paper based, where there's people that are really making either funds or that they can be invested in, or the ability to trade in honest real assets?
Yeah, that is in terms of buying mining shares and stuff like that, Dunnigan?
Well, I think
what you're getting at?
Actually, it's in terms of where the shares actually are backed one for one with physical precious metals, and not just this what we've been told is 100 to 1 or 30 to 1 or 300 to 1, depending who you ask about these non-segregated storage, where you have a claim ticket against a metal that may or may not be there in these various ETFs and that sort of thing.
Right. Anytime you're dealing with any of that, again, it's just a confidence game. And like anything else, it's you're a counterparty to whoever issues those things, hoping that there really is the gold behind it. I mean, allegedly, the GLD has added about 50% to its inventory of gold this year, 300 some odd metric tons, 10% of what the world will mine this year, allegedly has gone into GLD. I mean, no rational person believes that. But if you just wanted a proxy for gold, if you wanted to, play some bets and try to make a little extra cash, okay. But don't think that that's actual gold. Nobody should think, oh yeah, anytime I want to get my hands on the, I can just cash my shares in. No, you can't. No, it doesn't work that way. Now, that there is a time and a place for some of these proxies. You could say a mining stock is a proxy for gold in a sense. And some people love the mining shares because they worry that at some point the government is going to confiscate gold and silver like they tried to do back in the 1930s. And no one thinks, well, they probably wouldn't confiscate mining shares. And so some folks really like mining shares. Either way, I mean, it depends on what your goal is. If you're trying to actually make money, and I say that like make currency, make fiat, turn $100,000 into $200,000, you can certainly do that trading these gold-related instruments. But if your goal is protection, to get away from the madness because this is madness. And we had a Fed goon, as I call him, one of these Fed governors last night overseas talk about that the Fed should do helicopter money. And what do I mean by helicopter money? Remember, we tried that in 2008 already. You remember when President Bush issued everybody about a $2,000 check, a stimulus check? Remember that?
Yep.
That's helicopter. That's helicopter money. That's what people say is coming. Just simple creation of money and handing it out to people and tell them to go. I mean, this is madness. And your only protection against that type of stuff is to do what huge dollar countries with huge dollar reserves are doing. The Chinese buying a little bit of gold every month, about 15 metric tons. The Russians, big dollar reserves, buying a little bit of gold a month, 15, 20 metric tons. India, Iran, South Africa, Brazil, all these countries that have big, massive dollar reserves either are currently or have in the past or will in the future swap out their dollars for gold on a regular basis. And that's exactly what the regular individuals should be doing too, for the same reasons, just to protect themselves and be ready for what's coming next.
Now, you mentioned the failure to deliver being a trigger, potential trigger, no matter where it may come from. What is your opinion of the Germany about a year ago demanding their gold to be returned and being told, give us several years to pull it together because we can't deliver it to you?
Yeah, that was an eye-opener for a lot of folks too, Dunning, and no doubt about it. And then not only that, the gold that they were getting, they were demanding it being recast and re-refined and all that kind of stuff. And there was a lot of speculation that they weren't getting their 99.9% pure gold back. They were actually getting the 90% pure, what we call coin melt bars that the U.S. holds from when they melted down everybody's coins in the 1930s. So there's still a lot of shenanigans swirling around that. Why would it take 7 years to get 300 metric tons shipped across? You could do that in a couple of 747s, in a week. Oh, but it's logistics. Give me a break. Yeah, that was a real eye-opener for folks. And again, that was something where that's not technically a delivery failure, but that's the kind of thing that just tells you how tight things are. Where, the London Bullion Market Association, LBMA, used to print all kinds of helpful statistics. One of them we called the GOFO rate, the London Gold Forward Rates. And we found, when they printed these, it was a way to track how tight supply was in London. And if rates were positive, that told you that everything was normal. When rates were negative, that meant supplies were tight. And for 25 years, up until 2014, rates were negative for 7 days out of 25 years. Then in 2014, they spent about 6 months out of 12 printing negative rates. And it got so bad that what do you think the LBMA did? They stopped publishing the rates because it was too obvious as to what was going on, that supply was tight and they didn't want to run on their banks. They're basically living as a supermarket does. That there's what we call this just-in-time delivery, right?
Sure.
Where this loaf of bread gets stocked and a couple days later, all the bread's gone and some guy comes in and stocks some more. But what happens when there's, a hurricane coming or a blizzard? Everybody goes to the store once and cleans out the shelves and there's nobody there to restock it, and all of a sudden it's just gone.
We've lived through
that's a kind of a good
events.
Yeah, and that's a good metaphor for what's going to happen with gold.
So on your channel, you provide daily and weekly updates of the situation as it's unfolding for your viewers. Could you give us a little bit of information if our people want to find out, if they want to keep track of what your analysis is as things move forward from here?
I'd be happy to, Dunnigan, and thank you. I'm getting a lot of compliments lately for keeping people focused and in the game the last 4 years, and not just giving up and not going back to devalue, dollars, but buying more metal as prices come down, and averaging in. And we try to stay on top of it on a daily basis, too, because people are still buying. And though the service at TFMR is, a couple dollars a week, it's $12 a month. If we can help you to time your purchases, on the information we provide, whether it's, some people trade off of it and, get the value out of the $12 a month that way. But some people just time their physical purchases. If you're going to buy 50 ounces of silver, if you can save yourself, 50 cents, that saves you $25, right? And so I think folks are finding a lot of value on the site. We talk with a lot of important people around the globe and give our subscribers access to them in webinars every week. I think it's a unique place. The community is good. I know your show is called Reluctant Preppers. There's a lot of people that reluctantly are preparing for what they know is coming at TF Metals Report 2. And I would just encourage everybody to check it out, tfmetalsreport.com.
Well, Craig Hemke, founder and host of TF Metals Report, thank you so much again for joining us on Reluctant Preppers. We'd love to have you back, as this story certainly seems like it's going to be a dramatic one no matter what happens this year. It doesn't look like it's going to be a boring second half of the year. We'd love to have you back again to give us an update.
Donegan, it's been my pleasure, and please keep doing what you do. You provide a vital service to all your listeners and viewers. It's great stuff. Keep it going.